So, based on the few assumptions on how the outcome would look like, I'm going to devise a strategy based on put and calls on how we'll go about this. So, since we are selling put and calls, we would benefit if nothing happens. We are playing against the idea that the volatility is exceptionally high, and we would assume that it would not soar again on the direction. So, based on the bets, just a second. So I'm making a few bets here and looking at how to implement that using the put call. The first bet is a dangerous bet. It's a directional bet that I generally don't take, but I'll take a limited bet out of that, which is that Amazon is coming down by 5 to 10% in the coming next 2 to 3 months. That's my bet one. And suppose my bet two is that I'll short volatility if it crosses 50%. How would I implement these two ideas using the derivative market? So, to if the volatility increases more than 50% implied volatility, which means that option prices are higher and people are willing to play high prices, which we also saw in the chart when we said that the volumes of option have increased. So if you see here, the option market is selling a lot of put and call. So I would short put and call. I would short a put and call either for a month duration or 2 months duration. If I'm short on the stock, which means that I believe that it would come down, I will sell more calls, because if it comes down, then I'll get the call premium. So I'll short calls with a maturity of 25%. So this is how I would benefit from my those bets. Now, if you have some different bet of outcomes, you could implement that using. So one bet is that if all the risk is gone and no more spikes remain, and the speed at which the implied volatility is going to come down is lower in the market, people are scared for nothing, then I would go short on volatility. So this is the same as what was happening in the implied volatility, since the risk increased a lot in recent times. So we saw that the implied volatility reached 40% for nothing. There was no war, no outrage, but the Chinese bubble increased the implied volatility. The implied volatility is still very high, 27, as we compare it to the past. Earlier it went to 25 in October 14. I'm not sure what was happening that time. And in the last 5 years, such a high implied volatility, means 25, was observed only when we have the Euro crisis, the Greece crisis in 2011.